And then the reality takes over. We have a government bond crisis that we've been pushing off for decades, and it's going to, have massive wave effects. That's the kind of atmosphere I'm looking for, and I think it's going to occur this quarter where you make this happy high. By the way, we did a study in the weekend report. The market is not making new highs. NASDAQ 100 and the S&P are, but it's really the S&P 5 that's making new highs. Because when you look at the subsectors within the S&P, like XLF, financial sector, industrials, healthcare, you're going down the line, consumer discretionary, which is a high-risk sector, supposedly, consumer staples. All these sectors are collapsing relative to the S&P on spread charts. It will be the same. And a lot of people like to think of silver as an industrial metal. And if you go back and study, for example, the Bloomberg Commodity Index going back decades, and look at copper, for example, or oil or any of these things, they tend to move in large waves with, not necessarily month to month, but big move to big move, with the Bloomberg. In other words, they move like a commodity. Okay. Silver doesn't. Silver moves with gold. And there are plenty of times. So, for example, gold made a bear low in 2015. It went up and doubled by 2020. It went from 1,050 to over 2,000. Okay. And then went sideways for a couple of years. But it doubled in price during that same late 2015 to mid 2020. The Bloomberg went down the whole time. Commodities went down. Gold was going up. Silver went up with gold. Okay. So I expect them to trend together, but I do expect gold to create something dramatic, but it won't be percent-wise anything like what I expect out of silver in terms of relative performance. So yeah, watch gold. It's a good place to be, but silver during this move to a new reality is a better place to be by far. And so are silver miners versus the gold miners. And when you plot charts, spread charts, relative performance between silver and gold, you could see that back last November, we took out a 10-year range high at very low relative levels, silver to gold, like 1.5% area, or closer to 1%. Okay. Heck, in 1980, it was 6.5% the price of gold. In 2011, it was 3.1. And right now, we're still under 2%. So if silver even just regained some of those old highs on the relative performance, it's already taken out those price highs. So why doesn't maybe the relative performance is going to catch up as well? Then silver will double, triple, or whatever versus gold. And the same with the silver miners versus gold miners. If you plot them as a spread chart, you can see they broke out several months ago. And sure enough, since then, silver miners have actually month to month been beating the gold miners. Nobody notices that, but it's a measurable event. And I think that's where you want to be in the monetary metals. Where could gold go? I don't know. All I can say is twice before, since legalizing, it had two eightfold moves. Different time spans, but both were eightfold dimension gains from bear low to bull high. I've said this before to you on your show. And if we have another eightfold move, it'll be $8,500 because our last low was $1,050. Now, even J.P. Morgan came out with a report several months ago, fundamentally based, no doubt, that argued for $9,200 gold as a working target. I don't think it's a target. I think it's merely, I did it again. I've had another eightfold move. Well, that's nothing extraordinary. It's done it twice before, eightfold gain. This time we have fundamentals that are far more dynamic and nuclear than any ones we've ever had before. We have a government bond crisis, like Jamie Dimon told us 2 weeks ago. You got a government bond crisis now, and we're going to have to deal with it. And he didn't mean 10 years from now. He meant it's coming. It's now. We can't keep pushing it off. So that's an event that the public and financial TV really hasn't put up front as a major issue. I don't know why. That's fine. They'll figure it out later.
While gold remains the traditional safe haven, silver is increasingly attracting attention because it is historically undervalued. If the silver to gold ratio simply returns to past highs, silver prices will multiply rapidly. Investors are realizing silver mining stocks act like leveraged plays, amplifying gains during commodity bull markets.
Probably more than silver. Yes, I agree with that. And if you measure them historically, like even the gold and silver miners via the XAU index, which has both silver and gold miners. It goes back decades to 1980s. And if you look at it, it's like 8% XAU divided into an ounce of gold. Heck, it used to live in a range for decades that oscillated with a median about 25%. It's 8%. There's a base we're trying to break out of. In fact, XAU marginally nipped out of it a couple of months ago in the recent surge, and it pulled back a little bit. The relative performance readings I'm talking about. Divide XAU into an ounce of gold. Okay. 11-year wide range with a fairly clear ceiling. You punched up through it marginally. But when we do GDX versus gold, it didn't quite break out. It's pressing at it. It's like third time at the same level trying to get through. When we see both XAU and GDX break out on a spread basis above that 11-year wide range of relative performance at very cheap levels, at that point we think the miners will gush, not just in relative performance, but in net price in a way that will shock people. Now, what might motivate the miners more than the metals? When the public gets nervous about the stock market, and we think the stock market is in a topping process. We thought we would get a rally to new highs back when we were under pressure because of the quote war news. People selling that were stupid. They don't sell headline news. That doesn't top a market. Headlines come later, the real headlines, like federal government debt crisis, debt collapse, private credit, and so forth. Right now they're focused on, tariffs. Well, that worked for about 2-3 months if you shorted it, and you got killed. Okay? Tariffs didn't go away. And now the Iran thing. It hasn't gone away, really, and yet the market made a low and then shot up to a new high, which we expected. I suspect we're going to top out in this quarter in price, S&P. And when we start to roll over in a way that tends to upset the investor and analyst, in other words, get their attention, because right now they're all measuring new targets up there, and there's nothing but good news. That's the environment you want when you top. You want all to be happy news. Iran war somehow melts away, civil disorder there, and the revolution on the ground level, et cetera, or Ukraine-Russia war goes away. There's a lot of evidence that's about to happen because Putin is in political trouble in terms of maintaining power. There's elements within his government that, are PO'd at him big time. And there's a lot of foreign policy analysts in Europe, especially, and intelligence analysts who say they've been, he's been under extreme protection from parts of his the state structure that might want to overthrow him. And he's losing the war, and that's now pretty much admitted. I think even Xi recognizes it, that the Russians are not winning this war. And once that sentiment hits Russia, the populace, and the hierarchy in the government, they're going to say, what the hell are you still doing this for? You either quit or you're gone, okay? So that could end too. But wouldn't it be neat to have no more world uncertainty and the market tops with all smiles, and then the reality takes over? We have a government bond crisis that we've been pushing off for decades, and it's going to, have massive wave effects. That's the kind of atmosphere I'm looking for, and I think it's going to occur this quarter where you make this happy high. By the way, we did a study in the weekend report. The market is not making new highs. NASDAQ 100 and the S&P are, but it's really the S&P 5 that's making new highs. Because when you look at the subsectors within the S&P, like XLF, financial sector, industrials, healthcare, you're going down the line, the consumer discretionary, which is a high-risk sector, supposedly, consumer staples. All these sectors are collapsing relative to the S&P on spread charts. That happened back in 2007, and people ignored it. And finally, the market got the word, the S&P did, and collapsed as well. But right now, we're having it really inside the market. You're not doing what you think the S&P is doing. And so, but anyway, once that occurs, the average investor is going to want to do what? Well, they're not going to want to buy bonds. And he won't necessarily want to go buy silver futures or calls on silver. He might want to buy miners, stocks. especially the bigger ones. But anyway, I think that's when you may get the money flow that boosts the miners and catch up to silver and in valuation. The grain sector looks good to me. Grains look good. They're not explosive. They're broken out by our metrics to indicate the start of something. And they're very cheap, just like oil is. Cheap compared to their own history, cheap compared to the commodity category, cheap compared to the S&P, cheap versus everything. Cotton recently broke out, isolated, but it's still part of the complex. Copper, it's continuing up. Not explosive yet, but it went from 50 cents to $1.50 for multiple decades. Then in 2005, shot up to 4.10, and by 3/4. Okay. Then lived in a new reality with an average price of about 3, and then recently broke up above 5, taking out the old highs. Now we're 6.5 area. We're pushing. So it's probably going to $7, $8, if not a lot higher. But all these things are going up, so it's a good place to be. And I don't think you're chasing late, because this only just began, and this move is likely to last several years. And so from an investment grade point of view, I don't think you have to come in with call options or levered positions. I think you could simply establish a broad commodity-based or commodity stock-based investment portfolio in that category. And it's not going to be hot and frenzied at this point, at least. It's just going to be glacial. And then later on, it may get hot and frenzied. Okay. But right now, I think it's a great place to be. And I hesitate to try to pick which is the better place. Oil sector, grain related. I would throw a dart, basically say, you can pretty much throw darts at commodities, and you're probably going to have winners at each hit. Okay. Other sectors. By the way, I'd include uranium in that mix as well. Uranium stocks. It's had a nice pullback since its wake up bull move that occurred, peaked a couple years ago, a year or so ago. I don't think it's that dynamic, but I think they're all going to go up. Some of them may be more dynamic than other components during that process, but that could rotate as well. Trying to think of any other category. Most stock markets of the world look similar in the sense that if the S&P tops as we expect and shows evidence of the top in the third quarter, not this quarter, it may top this quarter, but not show the evidence that people see as a top. Other markets in the world, especially including bubble markets, like the Nikkei is a bubble market. We're a bubble market in terms of too much gain too long. Europe less so. China will likely top with us as well, but it is certainly not a bubble market. Its price is only double and a half where it was in 2009. S&P's 12-fold. NASDAQ 100 like 24-fold above its 2009 low. So their market is not bloated like ours. So it may trend down with us because, after all, China's part of the world economy. If the world economy goes into negative zone, then it's likely to hurt. But it isn't going to hurt like ours, simply because of what we did and they didn't in terms of the stock markets. But I can't find a stock market really to be in. For those that are more commodity related, such as you can call it a basket, the EEM emerging markets might even go up, but certainly not down like the S&P. So if I were going to play a sophisticated trade called global market neutral, $1 million in this and $1 million long, $1 million short, I'd short the S&P and I'd buy EEM and make money on the difference. So even if EEM did go down, it's going to go down. If it went down, it's going to go down a lot less than the S&P, so you make a lot of money on the spread. Okay, so that would be my stock market strategy. Global neutral.
Geopolitical analysts warn oil could surge to $200 a barrel, but the larger trend began before recent conflicts. Over the past decade, central bank liquidity flowed entirely into stocks, leaving real assets undervalued. Investors are now rotating into cheap commodities like oil, copper, and grains for long-term protection.
We look at all four major asset categories because, especially this day and age, you can't just have your blinders on and say, I'm long gold and silver, and I'm going to watch their day-to-day. And that's usually a mistake, too. Don't watch day-to-day. Doesn't mean jack S, okay? You can get even the last 3 months, you may look back and you will look back and say, hey, what a bunch of noise that was. So too many people are impressed by what happened today, not the bigger picture. And so we look at usually we focus on the larger trend pictures, the ones that matter, and relative status of categories versus categories, because that's what an investor wants to do. He wants to be in the better performing asset arena. And that is no longer the stock market. Gold and silver made that statement last year. They're the leaders now.